Hey, good morning, everyone. Really excited to have you guys back for another episode of Breakfast Trades. We're going to have a little fun today, do something a little different, and we're going to talk about how to get rich in crypto. Now, we all are here because this is a once-in-a-lifetime opportunity to make a lot of money in a new emerging asset class. We don't want to miss this opportunity, and we need to take advantage of it. So how do we do that? Well, it's not foolproof. There's many ways you can go about this, but today I'm going to share with you guys a little bit of my experiences, how I've been successful in crypto, basically how I went about it on my journey. Obviously, you guys, not financial advice, but I really hope you enjoy my ideas, and let's get into it. Step 1, do not risk your livelihood and your happiness or your family for crypto. You do not want to lose all of your money trading crypto or trying to trade crypto at the expense of losing your wife and kids. I've seen it happen. I've seen people go into mass depression from this type of thing. You must not risk everything to gain everything, especially if you're living comfortably right now. The worst thing you can do is have a very comfortable livelihood and lifestyle and lose everything trading crypto and have to live, a very basic lifestyle well below your original means. And then you're going to be depressed and you're not going to enjoy your lifestyle, and it's really hard to get out of that hole. Step 2, buy crypto. Woohoo, your favorite step. This is everyone's favorite step, but a lot of people go about it wrong. First off, you should understand what accumulation and distribution are. These are two very important parts of a market cycle that a lot of people don't really get. Look at Matic, for example. If you're not patient here and you go all in here and you have to wait for 2 years with your whole stack of money sitting sideways, you're probably going to sell because it's just going sideways. You're just waiting and waiting and waiting. So the best thing to do is dollar cost average on these sideways assets before they take off. Slowly dollar cost average on the dips over time. Every time you buy a dip, you are reducing your average cost. So if your average cost is 2 cents and you're slowly buying over this period of time anything below 2 cents, your average cost is now dropping lower, your dollar cost averaging, and you're basically giving yourself a better entry. Best thing to do, you guys, is just to slowly buy these, reduce your average cost, be patient, and don't panic. Don't go too heavy into one asset. Meanwhile, while you're dollar cost averaging into assets with good fundamentals, you can start learning about other asset classes, maybe higher risk asset classes within the space that can return very quick gains fast, and also maybe start learning how to trade, how to understand supports and resistances, and things like that. Step 3, build. All right, at first, we're just trying to build our accounts. Slow and steady wins the race. We just want to see nice, steady growth of our spot account. Now, if an asset goes up a lot, it's not a bad idea to shave a little bit of profit. All right, so we can increase our holdings if it does see some drawdown. So let's say that Matic, you've been dollar cost averaging and your dollar cost average is around 1 cent and it goes up about 200% and you sell 20%. And it goes down, well, now you can actually take those funds, buy back on that dip, and increase your holdings. So you'll actually increase the amount of tokens you have with the same amount of capital that you had. If it keeps going straight up, that's totally fine. You still have skin in the game. You still have holdings there. And you can take those profits that you just used and recycle them elsewhere into another sideways asset that you can start dollar cost averaging into as well. Step 4. Diversification. Now that you've actually built up your account is getting larger, it's growing, it's showing nice growth, and you've got a lot of funds in there that you don't know what to do with. So what do we go with it? Do we throw it all into leverage? No. Do we throw it all on Uniswap? No. We diversify. So maybe at this point we take some funds out of the market completely. We can put them into our bank account. This gets them away from the market exposure, and now these are zero risk funds. Crypto is still a high risk asset, even though over time we expect it to keep going up and up. For now, still a high risk asset, and having no exposure to the market is still obviously lower risk than and then having exposure. We could argue that a little bit either way, as no exposure means risk of missing out. My point here is that now that you've got a sizable account, you can start diversifying a little bit. You can take some of these funds out of crypto, put them into your bank account. You don't just want them to sit there though. And then you could consider diversification elsewhere into lower risk assets to diversify these funds and let them grow elsewhere alongside your crypto growth in a way that is just less risky. Get some of your risk off the table. You're playing more with house money now in your crypto accounts, and that's never a bad idea if you want to continue to build your wealth and build generational wealth to diversify into some lower risk asset classes and higher risk asset classes. Of course, now this is where we could start diversifying into other crypto asset classes as well. So a lot of people that just started in crypto in February, they took all their crypto funds, threw it right into Uniswap, and guess what? Most Uniswap tokens went down 50% or more since then. That is not a good use of your initial funds. That is not going to be a sustainable long-term approach. You basically just have to be there right time, right place, right time to get lucky enough to make tons of money on Uniswap right away. So we're taking a much safer approach here and being more cautious with our funds. And now we can get into Uniswap, leverage trading, and things like that. This brings us to step 5, leverage trading, Uniswap, NFTs, things like this. Now that you've built up a nice stack, start moving some of those funds over, diversifying a little bit, small amounts here and there. Start building up your leverage trading account. Start building up your Uniswap account. Start building up your NFT account, all right, your OpenSea account, and building a nice stash of NFTs that you can flip for more money. Doing these in small amounts makes it low risk. If one of these 3 accounts gets blown up, you've still hopefully got the other 2 accounts that are sustainable. If all 3 of these accounts blow up, you still should have your much, much larger spot trading account that hasn't blown up yet that you can build more on and then move funds back over to keep trying to build up these other diversified accounts. And now if your spot trading account gets blown up, which it really shouldn't because you can't get liquidated on spot trading, which is why I always preach having a higher amount of funds in your spot portfolios anyway. But if for some reason you lost your whole spot portfolio account or it went 90% down or whatever, you have your bank account and your primary source of income to fall on. Hopefully you've withdrawn some profits already. So if you really absolutely needed to, you could put some money back into your crypto account to start giving yourself a chance to build that back up again. If you completely lose everything in your crypto account, you have nothing to fall back on, you're basically starting over with less than where you're at before, and that gets really, really hard. Most people just start with one leverage trading account, one Uniswap account, etc. But once you start building these up, you can, again, withdraw profits, put them in your bank account, move leverage trading profits over to your spot account, however you want to do this, move them elsewhere, and start building up more accounts with different functions for each account and diversifying into multiple accounts, because if you have 2, 3, 4 accounts, you can't just blow up one account because you have these other accounts with money as well, if that makes sense. If all of your funds are on one account, you can blow up the whole thing. If you have multiple accounts that are built up, then maybe you blow one or you have large drawdown on one. You should still have the other 3 that are still viable and still have a large amount of funds in them. That brings us to our 6th and final step: invest, invest, invest. Basically what I mean by that, invest in other asset classes. I didn't really talk about it, but stocks are another one you can invest in, and you can find some lower risk stocks over there. Not only that, you can invest in property, real estate, businesses, people. The options are endless. There's so many opportunities. Once you've really built your wealth, you can start putting money into passive income accounts where you're literally just gaining interest for having money sit over there. That's another great way to slowly build at basically no risk. A lot of these accounts are just an APY. So you just throw money over there. It sits there for a year or 2. You gain a certain percentage. You get your money back. That has now gained in value. There's so many things you guys can do. Once you've built up your crypto accounts and once you've made good money, there's options everywhere. And it really just depends on what is good for your lifestyle and your interests and your hobbies. All right. Lately, as most of you know, I've been investing in or diversifying in Nintendo 64 items. So that's one way I can diversify. It's relatively low risk. A lot of the items I've bought are, at least worth what I bought them for, if not a lot more at this point. And I can't see much reason for their value to go down too much. And if for some reason everyone thought all that stuff was worthless in 10 years, then it's a very, very small portion of my overall wealth. End of the day, it's at least nostalgic for me and I enjoy having them. So at least I have that. Even if their value goes to zero, they still have value for me. So it's a win-win in that regard. Again, you guys, none of this is financial advice, but I really hope that you enjoyed some ideas for how to build slowly over time. And once you've really start building up your accounts, you can build quicker and so many more opportunities will come about. It just takes time. It's not going to happen overnight. So I really want to stress that. Be patient. Know that it might take 3, 4, 5, 6, 7, 8, 10 years, but you'll be happy with where you've come if you do it the right way, rather than trying to make it all in 1 month or 2 months and risking too much and just keep running into this slope where you might build up a little bit and then you get knocked back down hard. Nice, steady growth curve is the best remedy in my book. And overall sustainability over time and predictability of growth over time is more likely to sustain upwards in that regards, rather than more of a gambler mindset and more of, high risk, scared money don't make money type outlook. A lot of times that will just lead you down a bad hole. Hope you guys found some of these ideas useful and you can put them into your own practice and work them out the best that they will work for your lifestyle. But again, thanks for joining me for another episode of Breakfast Trades every Tuesday morning, 8 a.m. Central Time. Please hit the thumbs up and subscribe to my channel, and I will see you next time.